alternative funding for those real estate type companies as well. But actually my mom is a bit of a house flipper, and we just bought a house in Roseville that we're converting into like kind of a mother-in-law suite on the bottom. And then probably when she's done with that, she was an actual proper carpenter way back when, so she'll probably start doing maybe some more investing around the cities. So I'll be her little bird dog.
I'm Joel, and I have a duplex where I live right now. I'm basically looking to more of multi-families.
My name's Keith. I'm a real estate agent out of Keller Williams in Edina. Own a couple of rentals. Did a bunch of house flipping when the market was good, when you can buy them with margin. Just looking to learn right now.
Perfect. So our purpose for our meetup tonight is real estate investing really can be for anybody, but it depends how much time you have, how much money you have, what you're really looking to do. So active investing, buying properties, managing them yourself, fixing them up, can be a great way to build wealth, and that's what a lot of people in this room have done, and what I myself have done, and it's worked out very well. But it might not be the best strategy for you, and we're going to touch on a strategy called passive investing tonight, where you can invest with other people and not go swing a hammer or answer the phone calls about the tenants, or really deal with a lot of the aspects that make real estate investing active. Because real estate investing is an active investing endeavor. It's not passive. Well, not real estate investing yourself, buying properties is not passive at all. I think anybody here that manages rental properties can attest to that. Is you're not doing anything. You're going out and fixing things on the weekends, and you're answering phone calls. And even if you do have a property management company, like I have a property management company on 18 of my units, and I'm talking with them 2 or 3 times a week. I'm making decisions. I'm calling contractors. It's not that it is a lot of work, but it's still work. So if you really want to be passive, Todd's going to talk about how you can do that tonight and what it takes to get into that also. So I'll let Todd get started then.
Awesome. Thanks, Jordan, for having me, and thanks everybody for coming in the treacherous 4 inches of snow that we have. Blizzard. Yeah, so tonight we're going to talk about passive investing, and this is good for, I think, anybody who is investing, whether you're active or passive. You can use this information if you're going to at all use anybody's money, right? So if you're going, hey, you know what, I want to be an active investor, what do I need to hear this for? Well, if you're going to ever use anybody's money, I think this is good information to learn. So it's both for passive and for active people. So just kind of everything's more geared towards the passive investor on this. So just shift your mindset if you're going, hey, I'm not gonna ever invest passive, I'm gonna be active. Shift your mindset to think, all right, this is what I need to have my passive investors understand and what I need to be armed with to be able to answer. I don't know how to make a slideshow, by the way, so this is not that good. So somebody that does slideshows, I might need to hire you, because I do slideshows for my my syndications. Yeah,
there's a company that'll do it for. You can go Fiverr for $5.
I know. The last one I did was through Fiverr, but it's always a pain. So I need somebody I'd like somebody that's local, like make me some slideshows.
Yeah.
So I just saw that you can do it.
That's half of what I do.
Yeah. But will he give up some of your time? That's the key.
Absolutely.
And by the way, I need a social media person. Are you a social media person?
I'm not necessarily social
dang
media.
it. So I need that as well. It sounds like quite a few of you already know me. I went to college with one of you, so I think he knows me a little bit, but he knows me in kind of the less mature me. Now we're not going to get into those stories.
Save my stories.
Yeah, so I'm the owner of Venture Deep Properties, and I also host a podcast called Pillars of Wealth Creation. Some of you have listened to it if you haven't already. Put that down. I'd love to have you as a listener. I think we talk about some good stuff. I usually have some really good guests on it. So I also do some private coaching and consulting that I've kind of started doing recently, but I'm still an active real estate investor first and foremost. Husband and father of 2 awesome kids, and I'm also an avid outdoorsman and sports enthusiast. Actually, on Saturday, I'm going out to Montana to go skiing for 4 days, so that'll be awesome. See, terrible at slideshows. So I'm going to go real quick on who I am because some of you don't know, but a lot of you do. So I don't want to spend a ton of time talking about me. That's not what this is about. I used to be a high school shop teacher, and I turned into a real estate investor, and that was pretty easy because I was making like $30,000 a year, so it didn't take very long to replace my income. But it also was actually convincing my wife that it was okay to quit my job. So that was probably the hardest part.
And you still have all your fingers.
And I still have all, yeah. 1 to 4 family rentals is where I started. I was doing a lot of flipping. I was buying single families, up to 4 unit properties. I built a portfolio of about 75 units. I've since sold some of them, probably still, I don't count them anymore, but I think I have like right around 40 still, 45. I've done a lot of flips and wholesales. I've done about 150 flips, done a bunch of wholesales. I owned a ski resort, which doesn't sound as cool as it is, but it was still kind of cool. It was in southern Minnesota. If anybody's heard of Steeplechase? Yeah? All right. I bought a mobile home park in South Carolina. I've done some developing. I've done some seller financing, purchasing, and right now I'm doing multifamily syndication, which is why I know a little bit about passive investing. So right now I'm doing multifamily value add syndication. We'll talk about what syndication really is. And actually what David will be talking about is crowdfunding, which is basically syndication. Just, you know, David's got a...
Granular.
Yeah, I mean, it's the same thing. It's syndication. He's got a platform where he can kind of, well, through technology, you know, basically streamline it and all that kind of stuff. So he'll talk more about that. So first of all, how can we invest in real estate? I think most people understand that there's value in real estate, right? Most people get that real estate creates cash flow, and we can get this cash flow, and it appreciates at least with inflation, if not sometimes above inflation. So it's a great hedge against inflation. There's tax benefits, all this kind of stuff. So I think a lot of people, or everybody, in my opinion, everybody wants to be a real estate investor. A lot of people just either don't know how to be a real estate investor, they don't think they have the money to be a real estate investor, or they're scared as hell to be a real estate investor because they hear all these horror stories, right? The tenants, the toilets, the trash, they don't want that. They don't want the second job. They don't want to chase rents. They don't want a tenant to chase them down the driveway with a knife because they try to get the rents, which that's never happened to me. I know a friend who's had that happen to. So they don't want all these things that they hear about, like rentals being bad. They probably had an uncle or somebody that they knew that said, "Oh, rentals are terrible." I think everybody's heard that from somebody, right? You don't want rentals. They burned out somehow from them. So, but that's why a lot of people don't get started. And some of the stuff is true, especially if you don't run it as a business. And that's the biggest thing with being active. So a lot of people, instead of buying rentals, what do? They go flip a house, or they do nothing at all. They flip the house and they think they're a real estate investor, and you know, that's a whole nother topic. So what do most people do? Buy houses, actively manage them, or they manage a manager, like Jordan said. And they end up working on the house. You know, that you lose your weekends, you lose your late nights. Your wife gets pissed at you because you got to go to a building with a leaking pipe on her birthday as you were trying to cook her dinner, and then burnt it, and then went to the rental property and came back and she's in bed already. That happened to me, by the way, on her birthday. So she finished her own dinner, threw away mine, finished her own, and then...
Did she throw your clothes away too, or just the dinner?
Yeah, so that's what you end up doing a lot of times. You burn yourself out. You do all the work. You find the property, you renovate the property, you manage it, you rent it. You're the landlord. You're the slumlord. You end up despising that property. And then at the end of the day, you collect this stupid little check, and then you do your taxes. You go, holy crap! I actually lost money this year. Like, what happened? So am I making rental property sound really awesome? But this happens to the hobbyists. You guys aren't the hobbyists, you're here. right? So you guys are getting educated, you're coming to Jordan's events, and you're continuing to come to them, and you're getting educated. So you guys aren't the hobbyists, you're gonna end up doing it right, or you've been doing it right. The hobbyists are the ones that this happens to, like they get burned and they give it a bad name, and they do it over and over, and they never learn. So, did I skip a slide? Maybe. So what is passive investing? Putting your money to work in real estate without the hassle. No more tenants, toilets, trash, no more weekend phone calls. No more any of that. So I either skipped a slide or I gave you the wrong one because I added one. So I wanted to quick talk about active investing. And I've said it already, but if you're gonna be an active investor, you better understand that being an active investor is running your own business. And if you don't wanna run your own business, or you're not willing to put the time and the effort to it, you're not gonna do well actively investing. And that's, I think, the biggest mistake that most people make. They've got a job, it's a high-paying job, they go out, they buy a rental property or two, a duplex or whatever it is, and they think it's gonna run by itself because they know a guy like me or a guy like Jordan or a bunch of you guys here that have a handful of rental properties and you're doing really well. And you're successful at it. And they go, well, or they know a couple guys that own some apartment buildings and they're doing well, and they go, well, I can do that too, right? So they go out, they buy this duplex or this rental house, and they don't treat it like a business. They want it to be passive. So they hire a property management company, and they get this property management company on there, and they go, okay, you know, here are the keys, go ahead, and they don't want to ever look at it again. And then they wonder why they don't make any money on the stupid thing. Likely they probably overpaid because they didn't learn and all that kind of stuff. So if you're going to be active, you need to be active, right? You need to actually learn how to run the business and do it right. Jordan, you're active. Do you make money on your rentals?
Sure. Yeah, absolutely.
Jordan, do you run it like a business?
Yeah, and I'm working on it at least 10 hours a week.
Right.
So it's not passive at all.
I've got these 40 rentals around here. I've got about 500 units in all, and I'm working on them on a daily basis. And I have systems set up and processes. I've got people that I hire and I fire. I've got tenants that I hire and I fire. Okay, we've got our maintenance team. We've got everything set up to where it's running like a business. Now, I'm still very active, right? Just because I have set these systems up doesn't mean I am not active. So you have to be active. That's the key with active investing. Can you be really successful doing it? Absolutely. The cool thing about being an active investor is there's some advantages, right? So you can leverage your property. So you can leverage your money. So if you have $30,000, you can buy a bigger property than $30,000 will buy. Okay? You can refinance that property if you create good cash flow and good equity, right? So that's really cool. You can control it, right? You get to decide who you put in it. You get to decide what repairs get done. You get to decide when you sell it, all that kind of stuff. So that's really cool. So there's definite great advantages to being an active investor. All right, so I'm going to talk mainly about syndication, which I said syndication and crowdfunding are basically, you know, one and the same with some nuances in the differences. But we're going to talk about these four things. First of all is triple net lease. Triple net lease is buying, think of like it as the Walgreens, right? So you're buying the Walgreens, the actual real estate. You're not buying the business Walgreens, but you're buying the real estate that Walgreens parks its business in. They'll sign a 20, maybe even a 99-year lease with you. High credit tenant, Dollar General, but you can also have smaller companies too that maybe don't have quite that big credit, you know. So triple net lease, what they do is they pay for all your real estate taxes, they pay for your insurance, they pay for all the maintenance, all the utilities, all that kind of stuff. It's kind of mailbox money, right? Open the mailbox, you got that check from Walgreens. You don't have to do too much. Now you still have the real estate, so there still is some work, but that's very passive, very little. Now, what happens if that tenant bolts? Well, now it becomes really, really active because you've got to get a new tenant in there. Likely you have to do a build out, all that kind of stuff. But especially if you've got a really good anchor tenant like a Walgreens, I don't think they're going anywhere. They've been around for a couple of years. Hard money lending, I would say this is fairly active still, but more on the passive. Hard money lending or private lending on flips, you're going to get good returns, but you're going to have to find somebody who's good and competent at flipping. You're going to have to do some marketing to be able to try to get people to put their money with you, or you put their money with them. So it's a little bit, and then you want to do some due diligence on them. With all of these, you have to do due diligence on them. But so hard money is where let's say Jordan's going to flip a property. He buys a property puts a property on contract for $100,000, and he's going to renovate it, put another $50,000 into it. I give Jordan a loan for, let's call it $120,000. Maybe I even give him all the $150,000, but I give him a loan to do that property. 6 months later, he sells that property. He gives me my principal back, my $150,000 that I gave him, plus he gives me whatever interest we decided on. In hard money terms, that's usually about 12, 15%, and then usually he pays me a couple points up front, 2 to 3% up front on the loan amount too. So that's hard money. REIT, everybody know what a REIT is? Real Estate Investment Trust. Publicly traded, so that's a big advantage of that one. It's big companies, so they're typically very well managed. They typically have good, strong track records. You can get in and out quickly because it is publicly traded. Disadvantages, you're probably not making quite as much money as you possibly could other places because they buy kind of trophy assets and they don't have as much kind of value add, so your returns are still good, but they're maybe not as good as hard money, even triple net, and syndication.
So 4 to 5% on REITs typically, right?
No, REITs are higher than that. REITs are typically anywhere between they've been averaging anywhere between about 7 to up to 12%.
Okay.
So they've been doing pretty good. I think over the last 5 years, REITs have averaged about 8.6%. So
And that's is that always a cash on cash number, or is that like a total return number?
Total return, right?
Yeah.
So you've got distributions on the REITs, and you've got your equity value increase. The last thing, syndication, crowdfunding. So what is syndication? I think that's what I say. Syndication is pooling money together to buy a piece of real estate. So I got a property, right? I put a 100-unit property under contract. I need to raise $4 million, okay? You guys are all gonna put money into this property because you wanna buy a 100-unit property too with me. So everybody here puts their money, we all pool together, and we come up with $4 million, or what did I say, $4 million? $4 million. We come up with $4 million, and now we're gonna buy this property. I'm gonna manage it because I'm the expert. You guys don't wanna be part of the management, or maybe you do, but I don't care, right? So you guys are the limited partners, you're called. So you're the limited partners, your risk is your money, okay? You're not tied to the loan, the tenant slips and falls, they don't sue you, all that kind of stuff. So your risk is your money. So you put 100 grand into it. If everything goes terrible and we lose the property, you lose 100 grand. But you don't get dragged through the court system, anything like that. Just like if you put money into Walmart stock, they're not going to, if Walmart gets sued, you don't get sued. Okay, very similar. So there's a limited partner and the general partner. So in this case, in this scenario, I'm the general partner. I'm running the deal. You guys get your portion for being in the deal, and I'll talk about that in a second, and then I get my portion for running the deal. I'm also gonna, in my case, my company, I also invest alongside you as well. So, like I said, LP's risk is the money. And then when we do that, usually the limited partners get about 70%, sometimes a little bit less, sometimes a little bit more. So the limited partners get about 70% of the profits. So if we make $1 million in NOI, net operating income, or should say just cash flow. We make $1 million in cash flow. You as investors, as an investor whole, would make $700,000. Okay, because you're getting 70%. Now there's usually a preferred return, 5 to 8% preferred return, and what that means is if you gave me $100,000, I'm going to give you the first, let's say it's a 7%. I'm going to give you the first 7% before I take $1 as a general partner. So you give me $100,000, I pay you $7,000. Once I reach that $7,001, then we start splitting 70-30 from there. Okay, sometimes there's a catch-up provision, sometimes there's not, but meaning I catch up to you. Okay, so it's 70 or $7,000, boom, then I start getting paid. Okay, why would I do that? So I make sure I take care of my investors first. You're putting your money up there, you're trusting my expertise. If I can't provide a return, I don't deserve to get paid. Okay, so that's why a lot of people will do that.
Hey Todd, how long do you typically socialize that you're gonna, till you hit that point? Is it like 3 years, 5 years?
Typically preferred return goes kind of forever until either a refinance happens or a sale happens.
Is that
So-
refinance like year 3 typically, or?
There's no typical.
No standard.
I would say it depends on the property, depends on the value add, depends on all the expectations of the property. I'm doing one right now where we are expecting after 3 years. I've got one that we're about 8 months into it, and I'm expecting to do the refinance within about 4 months. So if we do that in 4 to 6 months, if we do that in 4 to 6 months, the investors will get a big portion of the return back. The preferred will essentially get wiped out. So, and again, you can set it. Here's the thing about a syndication. There's regulations, right? The SEC is who's in charge. The security, is a security that you're selling, but there's no like standards, complete standards. So I can give an 80-20 return. I can give a 70-30. I can do a 65-35. It really depends on how I tell my investors what the expectations are. And if the investors say, okay, I like that, then we're all on board, right? So it's all about communicating properly. And that's what I would look at either if you're going to be doing something like this, whether you're doing a syndication or whether you're taking somebody's money for a flip. I don't care what it is, it's all about the communication with your investors. If you're looking at passively investing with somebody, it's all about how can they communicate. You understand everything from start to finish, and if you don't, can they explain it to you? So if they can't, I wouldn't do it, right? I wouldn't be a part of it. And if you can't do it yourself, well, don't expect anybody to invest with you. Any questions on this kind of syndication setup? I think, 2 weeks from now, we're going to be actually talking about syndication.
April 26th.
Yeah, so April 26th,
Yeah.
we're talking more about how to set up a syndication and the whole process and how to find private investors and all that kind of stuff. So that'd be a cool one to go to if you're interested. It won't be snowing. Everybody here is here because they like real estate, so some of these slides I thought were cool to share with your private investors if you're going to take private money, or just to share with you so you guys can see. But why real estate? Well, it's a hard asset, high probability of success. People need a place to live. People need a place to do business, right? That's not going away. I know Amazon is taking over the world, But guess what? Retail actually grew in 2018 and is growing in 2019. Physical, hard retail spaces are growing. What's going away are some of these big behemoth box stores. Okay? People want that experience to go into a small shop especially and see the product. I think that Amazon is putting in actual physical stores too. So I think physical stores aren't going away. People need a place to live and do business. And by the way, you're never going to get your hair cut on Amazon. I don't think so. You never know. A drone might come and do it.
Your last haircut, maybe.
It's easy to leverage. That's cool. Banks are definitely willing to lend on real estate. One of the reasons why I like multifamily a lot is because lenders are really, really eager to lend on multifamily. They love it. Fannie Mae and Freddie Mac, the two big securities, mortgage-backed securities, they've got phenomenal products that they won't put into a lot of the other commercial. So you can get just unreal rates, unreal terms. I think it's fantastic. HUD's you can do 40-year plus on some of theirs at super low interest rates, which is unreal. So easy to leverage, easy to add value and increase returns. That's another good thing. And I say easy, it still takes a lot of damn hard work, but we can do it. And then phenomenal tax breaks. And I'm not going to tell anybody how much I paid in taxes last year because this is being recorded. But let's just say there's good tax breaks. I love it. So this might be a little hard for you guys to see, but real estate has had better returns than stocks, and it's less risky than everything except government bonds. So this chart shows the risk, and this shows the return. So real estate return is way up here at about 9%, where you've got the large cap and small cap stocks here between 8 and 9%. Corporate bonds at just over 7%. Government bonds way down here, commodities way down here with a high amount of risk. So you can see real estate risk is actually just slightly greater than government bonds, yet the returns are better than stocks. So that's why I like real estate, right? We get better returns, we get lower risk. Kind of sounds like a good thing to me. That's something that anybody who's like arguing with you about real estate versus stocks, you can show them this. And if anybody wants that, I can share the slides with you. And I can get that slide for you. Or if you're talking with investors too. Multifamily has the lowest risk profile. This compares multifamily then to retail, which is actually tied. Industrial, office, private equity. You can see NASDAQ, Dow, and S&P. So it's actually beating all of those, risk versus reward categories. And then here is compared. And the reason why I'm bragging up multifamily is because that's what I do. So that's what I can research. During the last 14 years, multifamily have had delinquency rates of less than 0.5%. So when we had this big mortgage crisis, I don't know if anybody remembers that, but there were some foreclosures that happened in like this 2008 to 2012, 13 time. That's been a long time ago, so you guys probably forgot about it, but it did happen. You can see multifamily jumped up to about 0.5%. Big spike. Okay? That's why I love it. And you look at any time period, the multifamily has been very steady, below 0.5% throughout its history.
That's why lenders like it, let's face it.
That's why lenders love it, right? People need a place to live. Now, is there risk? Sure. Can you run it into the ground? Absolutely. Do I see that? Do I buy distressed multifamily? Yeah, absolutely. So is there some risk to it? For sure. If you don't know what you're doing, if you think you're going to buy a 100-unit building and be a passive investor, when you buy that building yourself, you got a rude awakening. You need to run it like a business, right? All right. So what are my returns? If I do this thing, if I invest passively, or if I'm gonna be talking to somebody that wants to invest in my stuff, what are my returns? Well, typically, I talked about, and this is a syndication, typically the GP gets 20 to 30%, LP gets 70 to 80%. GP gets a 1 to 3% acquisition fee, so what is that? I get paid based on the purchase of the property, right as the property closes. So if I purchase a building for $10 million and I get paid 2%, somebody with quick math, what do I get? 200 grand. Right? I get that right up top. GP then gets a 1 to 2% asset management fee based on the gross revenue. So if the gross revenue is $1 million, I get 2% of that. What do I get? 20 grand. That's for an asset management fee. That's before the profits. Why do I do that? Because I got all kinds of overhead, right? I got a bookkeeper, I got an accountant, I've got people that work for me, I've got to get statements out, I've got to do a lot of work in order to get you your money. So I've got to pay for all my overhead. I take plane trips to the property. You know, I'm at the property, so I'm not actually billing an hourly rate. It's just my overhead. So that's what I typically would charge. And then, like I said, usually there's a preferred return. So syndication payment, what are you looking at? If you're going to either do it or invest in it, typically 6 to 10% annualized return. Call that cash on cash. So if you give me 100 grand, you can expect to get $6,000 to $10,000 annually on 100 grand. That's not amazing, but then we got to look at the whole picture, right? So when the property is sold, the investor gets their share of the profit on the sale and the profit on the mortgage pay down, which is awesome because the tenants are paying our mortgage, right? So what do we expect? About a 14 to 18% internal rate of return. And if you don't know what that means, basically it's, we take into consideration the time value of money, so if you could just keep on reinvesting that money. 14 to 18% based on a 5-year hold. What does that do for me? If I'm trying to think of it on a financial basis, what does that do? If I gave 100 grand to the sponsor to buy this building, I'm getting my cash flow, and then at the sale I also get this big chunk, right? All in all, we add that up, I get my $100,000 back, plus I get another $100,000 in profit in about 5 years. So what am I doing? I'm doubling my money. So I take my 100 grand and I turn that into 200, and then I reinvest that and turn that into 400, 800, and you can see how it grows, right? So again, these are goals, they're not guarantees. The other cool thing, we can do depreciation, which is give us great tax benefits, and we have long-term capital gains, as long as we hold the property long-term, right? If we're just flipping it, flippers don't get long-term capital gains, they get ordinary income treatment, right? So if you're flipping a property, you're gonna pay your ordinary income, you're gonna pay that 35%, you're gonna pay the state, all that kind of stuff. If you're holding it long-term, you're gonna pay short-term, big difference. If you're holding it long-term, you also have the option of doing what's called a 1031 exchange, where you can exchange it into another property tax-free. If you're flipping, you can't do that. Okay, well, legally.
And those tax benefits are huge. I think it's easy to overlook the tax benefits until you do taxes when you own quite a bit of real estate. I paid 0 taxes on the real estate I own this year.
Being recorded, Jordan.
We what?
You're being recorded.
Well, it's just the power of real estate. I didn't pay anything on the real estate I own, and I made money every month. And decent money. I didn't make enough money to fly to Italy or something today and not be here, but you know, I made enough to basically live off of, and I didn't pay any taxes on it. Not only did I not pay taxes on it, I actually had $8,000 more that I could write off on the real estate I own. So that's a big thing for people with a high net worth, is they can reduce their taxable income by buying real estate.
Yeah, and we can accelerate that too, so we can have even greater tax write-offs. We can do what's called cost segregation, where we basically pick this building apart and say, these screws that are in the drywall are gonna last 5 years. this appliance is gonna last 6 years. And we take this building and we like chunk it up, and we say, this is gonna last 5 years, this is gonna last 7 years, this is gonna last 10 years. And this is gonna last 27 and a half years. So we chunk it up and then we go, okay, now we can take more depreciation on these items that are gonna last less time. Yeah, that's huge. Not, you know, anybody pay any attention to the presidential elections? You probably couldn't get away from it. I can't remember the exact quote, but I think it was Hillary Clinton that was slamming Donald Trump for not paying his fair share of taxes, and his response was, because I'm smart. Right? Why do you think he's smart? Well, he's a real estate investor. He knows he's not dodging taxes. He's buying real estate, so he doesn't have to pay his fair share of taxes. Right? He's paying his fair share. They set it up for him. He's just taking advantage of that exact same thing. So that's because he's smart. And why do you think the Clintons probably have their big Clinton Foundation? It's because they're also smart. Right? They know how to do tax write-offs too.
Is the
pretty much-
holding period for capital gains the same for like a apartment building as it is for a single family, like 2 out of 5 years, or is it different?
Oh, so that's totally different. So what you're talking about is in a residence you're living in,
Right.
right? So in your own house that you're living in, you can sell it. You basically every 2 out of 5, you can do 2 sales in 5 years and still have it as a homestead and not pay taxes, any taxes. Where we're looking at any other piece of real estate, whether it's a single-family rental house or a 200-unit apartment building or a Walgreens building, you can hold that for long-term purposes and then sell it, realize a gain, and pay long-term capital gains. Now, what is that magic number? There's really no magic number. Most accountants will tell you, did you hold it for about 13 months? You know, but honestly, if you let's say you buy this piece of real estate, whatever it is. Let's say you buy an apartment building, okay? You start to do your value add to it, and all of a sudden some investor comes in and goes, hey, you bought that thing for $4 million. I want to pay you $8 million. Just sell it to me today. And you go, okay, here you go. That's long-term capital gains, even if it was only, say, 6 months, because your full intention was to hold that building long-term and keep it, right? You got an unsolicited offer. You didn't put it on the market. You didn't contact a broker. Somebody just came to you and said, hey, I'll pay you a bunch of money for that. So now you pay long-term capital gains. Now, talk to your accountant, because I'm not a CPA and I don't give legal advice and blah, 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 right? But as far as I understand the law, that's what it is. All right, so that's kind of syndication in a nutshell. I don't want to spend too much time on like the syndication, but I want to talk a little bit about triple net lease and the returns, and I'm going to talk about some of the other returns on some of the other stuff. So triple net lease, like I said, think of Walgreens leasing your building. Okay, you don't do much. Typically, you get 5 to 8% annualized returns, likely closer to that 5%. Unless they're a high-risk tenant. Then you're probably getting closer to that 8%. Walgreens is going to be maybe even 4%. Okay? Walgreens in like a really nice location is going to get you 4%. Walgreens in like east side of St. Paul, maybe 6%. Okay? So it also depends on the location. 10 to 14% IRR based on a sale in 5 years. So pretty good IRR still, but maybe a little bit less. Usually strong and secure tenants, and then you get the depreciation and tax benefits, long-term capital gains if you treat it that way. The hard money. This one you could probably get the highest returns on, but there's some disadvantages. One is it's definitely more active than the other investment strategies. You get 1 to 3% fee usually up front of the money you borrow. So if you borrow $100,000 to somebody, they're going to pay you a 3% fee on that $100,000. So they're going to pay you $3 right up front. Usually you get a 10 to 12% annualized return, and potentially even higher, right? Anybody know hard money rates today, right now?
I think it's pretty competitive. I think
Am I
you can
about
see
right?
you are, yes. You can see rates as high as 15%, but it's
Yeah.
not typical.
Not typical.
I would
Probably on a
say-
higher risk,
Yeah,
first timer.
first timers, stuff like that. Yep, yep.
Yeah.
I think you're right in. I think 12% is pretty much 12 to 10. 10% is
Yeah,
you're not going to get much better than that.
yeah,
Like,
yeah.
that's
You're
why
probably
we-
not gonna get under 10.
Yeah, I've read some sort of national statistic, yeah, that was like 10 to 15 was what I read.
Yeah, and when you really look at it, right, you're getting this fee up front, and then you're getting your 12%. That adds up pretty quick, right?
The one of the things that I think is a downside of hard money though is it's only on your money that's working, right? And it's harder to predict how long your
It
money's
is.
going to work at any given time.
Yes.
You're right, to
so
disperse it
it's
all.
velocity, right?
Yeah.
You have to get your money in and out quickly. And the faster you get it done, the better, because that 3% happens every time you get it out. So your goal is to get it back and get it back out, because you get that 3% right up front. So if you can do that quick, if these are 6-month turns and you've got it like clockwork, you're gonna make really good returns on your money. Because if you're making 12% and you can do that 2 times, now you're making 18%.
Right.
Right? And so we make a really good cash. That's a great cash on cash
Right.
return.
But if 50% of your money is not in use for 4 months out of the year,
Now,
now
you've
all of a
gotta
sudden,
take,
that shrinks it down.
yep, you got to take that whole picture. Or if they don't perform, and now you got to take the property back. Now you're
Yeah.
talking about a totally different situation,
Correct.
right? And it's definitely higher risk. Flipping, when I talk about the risk of real estate, flipping is not in any of the categories I was talking about, right? Flipping is development. In my opinion, flipping is not investing. You're a developer. Okay, so don't take offense to that if I called you a developer, not an investor, but that's my opinion. So money's typically returned 6 to 12 months. They're quick loans. You can usually you provide maybe an extension or two, and they have to pay you some fees to do an extension. There's no tax benefits. All short-term capital gains. Money's coming in, coming back, coming in, coming back. Going on. Yeah. Higher risk and a little bit more involvement. But if you do it right, if you've got a machine working, I know people that make really good money on it.
Mm-hmm.
Excuse me. Maybe this gets into private money, but why aren't there people with hard money that would loan it out for like 2 years?
There are some,
and like 12%,
right?
or a longer term loan where somebody has a chance to develop the property and
Yeah.
finance.
First of all, there are some,
Yep.
but not many. And the reason why is again, that velocity. They make
Yeah.
money on their fees, and it's because they try to set up systems and processes and make it streamlined, right? So if they're trying to adjust for different people, it just becomes harder. So they got their business model very set up, their heads down, that's what they're doing. They don't want to adjust just for you. Now, there's private money, and again, that's part of kind of a hard money deal. You would offer people, when I was doing flipping, I told you earlier I did about 150 flips, I used mostly private money. So I would talk to people I know. I did it a couple different ways. First way I did it is I would offer equity. I would say, look, you invest in this property, I'll give you 40% of the profits. Figured out then I was giving them a ton of money. At times I was giving investors, I might even have it, I've got it on my computer, I was giving investors like 25-30% return on their money. It was, or even higher at times. So then I went, okay, I'm giving away a lot. I could do hard money. So I started changing that, and I was giving, and towards the end of my flipping, I was giving my investors 12%, just a simple 12%, no points, no nothing, just 12%. So you can set that up, find people that want to invest in your development projects, and be passive, and set it up however you want. The key is communicating why it's beneficial to them.
That would be more beneficial to whoever is loaning you the money too, because you have to pay 12% every month for 2 or 3 years. And it's hard to make a flip work at those terms. So if you've got a project, say even whatever you're doing, 12% is a lot to meet for 2 or 3 years. And I know a lot of flippers will not do certain deals if they don't think they can turn them in 3 to 5 months, because 12 to 14% is just too much for 3 to 5 months.
And I think,
Yeah.
Flipping's all about velocity.
Yeah.
I mean, you've gotta go fast.
and Todd, what happened to you obviously is you became confident in what you could do. You started to be able to show people you could make money, so your terms changed. But it was alright, it's safer for them.
Yeah.
In the end, your 12% was,
Yeah.
in some ways, you could say a better deal. And I made more on the other ones. The other ones, they could have lost their shirt, whereas on the 12%, it's pretty much I know I'm going to get my 12% from Todd at that point in my career, right?
I had some investors that they questioned it, right? Because, geez, I just made 26% on the on this deal, and now you only want to pay me. First, I went to 15%, so now you only want to pay me 15%. It's like, yeah, because I'm giving you a lot of money. Like, it's either, and I was finding banks then that were lending to me, so it was like either, hey, you take it at 15, or I'll get the money somewhere else.
Yeah.
And eventually they all said okay.
Right. Because they realized that you were right.
Right, and they're still getting good returns, right? And they're relatively safe because I already done 50 of them or whatever it was at the time. REITs, 9 to 12% or slightly lower than 9, I guess. Like I said, at 8.6, I think was the most recent 5 years. Typically you get quarterly dividends, very passive, easily traded, no tax benefits. I shouldn't say that. No depreciation benefits. Now, if you hold it a long time, you still can get the long-term capital gains. So why passive investing? Demanding job, high-paying job, right? If you got a high-paying job, it's hard to quit your job to go do real estate, especially just to start out. So I know several people, that they had a high-paying job and they would take all their profits, all their excess cash, and they'd invest it into syndications, and they're retired now.
I know a very successful passive investor, and he went to Spain today just because. And I guarantee he didn't sit in the back and coach either. So he can do that multiple times a year, because he had a high-paying job for a while, but has been retired for 20 years or so.
I mean, you think about it, if you can invest, most people in this room can't do it, but if you can invest, a few $100,000 each year for about 5 years, think about the velocity of your money, and if you can double that money every 5 years, 5 years from the very first investment, you're really crushing it now. And that's what some of these people have done. They've invested 1 to 2 to even higher each year into these investments, and all of a sudden they're making massive money just on their cash on cash return. And then they get a sale every once in a while and they explode it. So, you get the tax benefits of real estate. So we file K1, so that passes through. So all the depreciation, the tax benefits pass through to our investors.
That's particularly helpful for someone with a high-paying, demanding job, right? Because after a while, like you're not paying taxes now. You probably have wasted depreciation, I would guess, that you could pass on your other investors as an extra benefit, right?
Yeah, if I don't sell a property, like this year I sold a couple of my single families, so my my losses that I was able to capitalize on for my apartments were able to wipe out those profits. But if I didn't sell those, then I would have a lot of
basically excess
write-offs.
Yeah.
It allows you to diversify too. Your financial planner tells you to diversify, but they don't tell you to do anything outside of the stock market, right? Mm-hmm. Maybe they'll tell you to go put some bonds and whatever, but it's stocks, bonds, and mutual funds. They don't tell you to go into real estate. Well, anybody know why?
They sell them.
Yeah,
Well, they don't sell real estate.
Yeah, they don't make any money on it. It's a big thing, okay? And if they advise you to go and invest somewhere and you lose your money, they're at risk of course, getting sued for something like that. So they just try to stay away from it. Now, some of them will. I know a few that will advise, but a lot of them won't. They won't even.
We actually have one that will advise in investing passively, coming to present in a few months here, so
cool.
Should be interesting.
Who's that?
Scott?
Oh, Scott Jensen?
Yeah, Scott, he started his own firm.
Yeah.
Didn't you have a financial advisor on your show that
I did,
was in
yeah.
real
He's a
estate?
passive investor with me,
Yeah.
and he's a financial advisor, and he very strongly believes in buying businesses and buying real estate and diversifying outside of the stock market. Now, what does that do for him? Gives him less business. But he doesn't see it that way, right? He's got an abundance mindset, which most people don't have. Right? If you have an abundance mindset, you see it as you're helping your clients. They're going to bring other clients to you, and you're still going to make as much and eventually more by serving everybody the right way versus trying to just protect your little egg that you have. So
That's why we started this meetup, by the way, too. A lot of meetups would say, hey, no agents or no lenders or no whatever come into here, trying to, they have the scarcity mindset of we got to hold on to all these people and not let anybody else in. And we really don't care.
yeah, look,
Anybody can come.
me teaching people how to do real estate, technically, I have more competitors the more people I teach. But I don't care. Like that's not my mindset. So the other reason why to invest passively is you can learn while making money. I get a lot of my investors want to do exactly what I do. So what do? They put some money with me in order to learn from me. So they get to see all the private placement memorandums, all the documents, they get to see the presentations, they get to see how we run everything, okay? They get to see our mistakes and they get to see our failures, they get to see everything we do right, and then they can take that into their own business. So that's another reason why some people do it. I've got a lot of investors that are like that. They want to do one or two deals, and then they want to go out on their own. So that's another great way of doing some passive investing. We've been going for a long time. How long do you want me to go for?
We plan until 9.
Until 9?
Yeah, so it's only 8:05.
Okay.
So you've got 55 minutes, buddy.
Yeah.
Boy. You guys want to listen to me talk for another 55
Can I
minutes?
ask you a question?
Yeah, I want. This is for you guys, so interrupt me, ask me questions.
So how, the advantage of real estate is your money is secured by a asset. Or,
Yep.
hard asset. So when you do syndication, what's the mechanism for securing of people's investment?
Hard asset.
I mean, so like, how does it transfer between the things recorded on title
Right.
and what people's?
So here's
money is
syndication. Pooling everybody's money together. We're buying this property together. It's not me buying the property. It's our LLC. So we all put our money into this LLC, right? So 123 Main Street LLC. 123 Main Street LLC, you own shares of that LLC. So if you put $100,000 into it and it's $1 million, you own 10%. You own shares. You own 100,000 shares. That buys the piece of real estate. So our LLC then owns the real estate, which our money is secured upon the real estate. So same way, it's just instead of you owning it solely, you and 30 other people own it together.
So it's established within LLC by contract?
Yes. Yeah, we have, our LLC bylaws, we have our all of our agreements. I mean, I and any other, trustworthy person is paying an attorney probably between $8,000 and $15,000. Yeah. So it's fun. It's a fun bill.
Todd, Anna from online wants to know what the minimum investment generally is for passive syndication.
Yeah, I mean, Anna, that's all over the board, but I would say your typical is about 50,000. Sometimes 100,000, sometimes less. Now, when we're talking about the crowdfunding, typically crowdfunding is a little bit less even. So I did a crowdfund that was 25. Do you remember what Mike's minimum was on his crowdfund?
I went 25.
Mike went 25.
Yeah.
So anywhere between 25 to 100K is the minimum.
Okay.
The problem with having too small, here's the problem with having too small a minimum, right? When I set a minimum, I get a large chunk of my investors that'll go in at the minimum. Then I'll have other investors that'll go wherever they want. So if I set a $25,000 minimum, I might
Got
get,
a heck of a lot of investors.
right, I might get 30 investors that'll invest at 25. But if I bring that up to a $50,000 minimum, I might lose 5, but I'll get 25 that'll go at 50. 25 times 50 is a lot more than 30 times 30.
Yeah.
Right?
We found that with our portal, we have the suggested investments. I think with yours, we had like the minimum was 25, we have 50. So it's a psychological term called anchoring and framing. So if you present a number, like the suggested amount, surprise, like 80+% of the investors will at least hit that number. So even if you have a minimum of 25, they'll see that number as the suggested, and they'll anchor on that. So you can set that number wherever you want it to
Yeah,
be.
yeah. And also, when I did the $25,000 minimum, I made it clear to people that I'm favoring anybody that puts in 50 or more. So if I cap out with 50 or more on all my investors, I'm not going to allow any of the lower investors to come in.
Yeah, if you become
Does that make sense?
oversubscribed, you just take the
Yeah.
big
If I oversubscribe, so if it's $1 million raise and I get 10 investors that all put 100,000 into it, I'm not going to take anybody that's wanting to put 25 into it.
Yeah.
So there, I'd say that's the biggest reason is it's harder to raise when the lower you go, it's harder to raise.
Do you generally try to oversubscribe a little just in case something happens, or what?
Very good question, and we'll talk about that probably at
I
the
think-
next meeting,
okay.
but yes, absolutely, because every time I get people that drop out. I mean, just.
Is there a certain percentage you go by, like 10% over? Like if I need $1 million, I'm gonna go for 1.1, or does it just gut feeling on each deal?
Well, I think you gotta feel out your crowd, but if you're doing your very first one, I would go 30% higher.
Mm.
Yeah.
It's true, some people just don't show up with the checks.
Yeah, I just yesterday had one of my investors say, hey, I got a business opportunity that came up, I'm gonna drop out. You know, he committed 50 grand. It's a verbal commitment. You start with verbal commitments first. The legal docs come out, everybody signs it, and then they wire their money. So until they wire their money, you don't know.
Sure.
100%. So you know, he dropped out. I had backups, no big deal. Somebody slid in. I guarantee by the date we fund, I'll probably lose another, probably 2 to 3 people.
Because it just happens,
It
yeah.
just happens.
Yeah.
Yeah.
Well, like you said, if they get another opportunity.
Yeah, I get mad at them, I swear at them, and then you know what? You just got to understand some people aren't going to do it, and if you understand that, you're setting yourself up for success. If you just assume everybody's going to do it, you're going to set yourself up for failure, and then you're going to be mad. You're going to be swearing at the people, and probably swearing at yourself.
Right.
Right. Yeah. Somebody else had a question?
When, let's say you're interested in passive investing,
Mm-hmm.
how do you evaluate the syndicator, or the person who's actually doing the syndication?
Yeah, good question. So that's really important. I think that's coming up. But that's really important. So how do you evaluate them? I would say referrals are big, references, right? Understanding that they've done business before and their track record. Knowing that they know the language, know the terms, know what they're actually doing and investing in, understand the market and the market cycle and where we're at. You know, there's people that are naive about where we're at. There's people that understand where we're at in the market cycle. You know, and I can't tell you exactly where we're at, but I do know in our market cycle, prices are high, rents are high, and there's bound to be an economic cycle downturn that's going to happen. And so, are they protecting themselves for that? And even if we're at the bottom, are they still protecting themselves for challenges up ahead? And so I would say that's big. You know, how are they underwriting? How are they being conservative? Are they thinking? And can they tell you the reasons why this is a good investment and the reasons why there's risk? If they can't explain the risk along with the profits and rewards, that's also, I think, a big red flag. because there's definitely risks. You know, in any of my investments, I try to talk to the investors about, you know, cap rates. Today, cap rates are compressed. So when I underwrite, I'm underwriting more at historical cap rates. So even if the cap rates, everybody know what cap rates are? Cap rates are basically if you buy a property for cash, the return that you get on that. So, you know, income, your income divided by your purchase price, right? So it's the return you'd get if you bought a property cash. So anyways, so cap rates are what real estate, multifamily, and commercial is sold on. And if you're buying at a 6.5 cap today, well, that doesn't mean anything. Where are historical cap rates? If historical cap rates are at 7%, we should probably be underwriting exiting at 7% or maybe even higher. You know, so are they being conservative like that? What happens if rents go down? Do they understand that? What happens if, you know, X, Y, and Z happen? So in all my investments, I put together a first page model. So it's a target, it's called my target model. And then my second page is called my scenarios. So I put together several scenarios that says, what happens if rents go down 20%? What happens if vacancy goes from 6% to 20%? You know, what happens if we can't sell at the 7 cap and now we have to sell it at 9 cap? What does that look like to our returns? Can we break even? Can we make money? Or are we losing? Okay, so I think that's really important. You know, who's on their team? Do they have a good team? That's really important. So who are their property managers? Do they have a strong company? Who are their you know, the employees that are going to be involved? Who are their partners potentially that are going to be involved? What else? I'm trying to think of what else.
What do you look for people? I mean, you talked about the underwriting, but maybe speak to the debt perspective of what kind of debt are they getting? And
Yeah.
that might make a big
Yeah,
difference
good
right
question
now.
on the debt. Now, debt is kind of, there's different reasons for different debt, right? So you've got short-term debt, which is in multifamily. It's called bridge lending.
Mhm.
That's a little higher risk, but also definitely a good strategy in the right situation. Then you've got kind of midterm debt, so you got 5-year fixed, you got 10-year fixed, longer term. So I would say on the debt scenario, are you over leveraging is the biggest thing. Like, do they have the proper leverage? Are they over leveraging? If they're putting that 80% plus debt on it, that's pretty risky. If the market fluctuates a little bit, they don't have much room. If they're doing, you know, if they're like 70% debt to equity, you know, now we're talking, we've got some flex there. If they're 65, that's even bigger. So I think that's big. I think the reserves, how long can this sustain in a bad economy? That's really important to me, more than anything. How long can they sustain in a bad economy? So for me, depending on the project, I'm putting anywhere from about 8 months of principal and interest all the way up to 12 plus months of principal and interest in a reserve account right from day one. I raise for that. You know, because if stuff hits the fan, we want to be prepared. I mean, these are things too. You know, do they know the niche that they're investing in? Do they understand the numbers associated with the investment? And same thing as a passive investor. Do you know your risk factors? Do you know your numbers? You know, get comfortable with the company. Probably the most important. Do they have a sound business plan? Right? Do they actually have a strategy in place? Really important. Or are we just buying a property because it's really cool and it can cash flow? Right? No, do we have a sound strategy? How are we going to raise income and lower expenses and increase our net operating income, which in turn increases the value of our property? There's a direct correlation from our net operating income to the value of the property, right? So if I increase I gotta try to do math in my head now. So if I increase my net operating income by $100,000, okay, and my property is selling at, let's use a 10 cap, which nothing sells at a 10 cap, but let's use a 10 cap because it's easy. I increased my building value by $1 million. Okay, my NOI, my net operating income, which is my income, my rents received, minus all my expenses, that's my net operating income. Okay, if I increase that by $100,000, I increased my value of my property by $1 million. Okay, so how can I do that? Now, if it's a 5 cap, which is more realistic actually, I increased it by $2 million. Okay, so that's actually a powerful little lesson if you heard that. People want to buy a 10 cap. 10 caps are usually more risky and in worse neighborhoods. But what did that do when I increased my NOI by $100,000 in a 10 cap versus a, let's call it a nicer property with a less cap rate, 5 cap? See the difference there? My 5 cap actually increased by $2 million, or to $2 million. My 10 cap only $1 million. So I just created $1 million more equity on the same building with increasing my profit the same amount. That doubled in value. So that's a powerful lesson right there. Sometimes it's not always best to buy the property that you think is that 10 cap, that you think would be better returns. Sometimes it's better to buy the 5 cap. Okay? But don't just buy a 5 cap and a 10 cap. Here's another thing I would say if you want to invest passively, study several different offerings in the niche and get familiar with them, right? Familiarity in anything you do is going to be better, right? If you're going to go buy a new car, or if you're going to go buy a used car, right? And you search Craigslist and all these other spots, you know when you find a deal if you've been actually searching and figuring out the market. You've been seeing that car that you want sells for $30,000 and all of a sudden, that one's at 24. I want that thing, right? That's what I did with my truck. They're all selling at 28,000. All of a sudden I saw the exact one that I had been looking at sold for 21. I bought it for 21. And that's what you do in real estate too, right? You don't go buy the first house you look at. You don't go invest in the very first offering that you've ever looked at. I suggest you looking in others, unless you're looking at mine. Understand the market you're investing in and the sub-market within. So understand where you're investing, get to know it. Hopefully that sponsor has good education for you and that you can actually learn that market with what they show you. Spread your money out into several different investments. I've got a lot of investors that come to me and they start talking to me and they say, I've got $500,000 I'd like to invest. If you had $500,000, what would you do? I never say, well, invest them all in my properties. I always tell them, look, I'm going to give you a couple referrals to a few of my friends that I know, like, and trust. I've got offerings I'll send you. If you like them, invest in those. But also invest in some of my friends' offerings that you enjoy too. That way your money's not just into mine, it's into other people's. Again, that's the abundance mindset. Just because I might lose, maybe they don't even invest in mine because they like theirs better, and they invest all their $500,000 into the 2 or 3 people I referred. Well, it is what it is. That's going to come back to me in the end. So that would be the last thing.
Diversification in an asset class. There's nothing wrong with being diversified inside of an asset class.
Absolutely. Right now I'm looking very strongly at self-storage, looking very strongly at mobile home parks, looking very strongly at light industrial. I have properties in Minnesota, I have properties in Ohio, I have properties in Kentucky, a property in Tennessee, and a property in Wisconsin. So I'm not just in one market. I am in one asset type right now, but I'm looking at diversifying throughout protecting my company as a whole. How do I find a deal to invest in? This goes to finding a deal to buy yourself as well. Networking. You guys are here. I suggest you meet, maybe not everybody, but meet a few people at this meeting. every time you come back to this meeting, meet somebody, get to know people, actually build meaningful relationships. If you're that ninja card guy, you're not gonna build any relationships. You know that person, right?
Yeah, the guy we were talking about earlier.
You know, you send out your business card to everybody, think you're gonna be their LinkedIn buddies. That doesn't mean anything. Actually get to know people and network. Meet people doing deals in the asset class you like. You know, biggerpockets.com, podcasts, real estate meetups. Those are all great ways to meet people that are in the business, doing the business, and actually get to know them and reach out to them. Of course, if you're wanting to invest, brokers, financial advisors, if you like the REIT idea, all about getting to know people, right? That's the only way you're gonna do it and actually get to know them. I flew up to San Francisco and Los Angeles last week for one purpose only. I've got a lot of investors and potential investors in San Francisco and in LA. And I wanted to meet them face to face because I know that's the only way to do business, in my opinion, is to meet people. I want them to know me and I want to know them, right? So I flew out there, I spent 2 days in the San Francisco area, I spent the day in the LA area, I held a couple meetups. I've never actually hosted a meetup before, I've just spoke at a few meetups, but I've actually held a couple meetups. I met a lot of mine, either investors or potential investors, and I met a lot of new investors and potential investors. So get out there, move around. Jordan and I go to conferences. Tim, I think you've been to conferences. I don't know, I'm sure everybody's been to some sort of conference. You meet a lot of people if you get out there. So, questions to ask a GP? What's their overall business plan? What's their underwriting? We've already talked kind of about the underwriting. Can the investment actually weather a storm? And then what their team is. You know, their general partner, their property manager, any other general partners, contractors, attorneys, lenders, so on.
And there's a reason why you have a property manager on its own there. Having a good property management company is so important. And not just on the smaller deals that I've done, I've been through a few. Some have been awful and I've lost money on the projects with having a bad property manager. And now I have a good one and I make pretty good money, so.
Yeah, that's huge. Property management is obviously, I mean, that's probably the biggest thing for success. You can find a great property in a great market, and that can hide a lot of mistakes, but the property management company is going to be definitely your best tool. You got I would rather have a C-class property in a city that's losing population and rents going down with a fantastic property manager than a city that's gaining in rents with a horrible property manager.
Yeah, because someone's gonna have to have vacancy, and you know, so if you're better than your competition,
Yeah,
they'll end up with a vacancy, right?
exactly.
And reviews anymore, if you're doing bigger deals, reviews on Facebook or Google or any of that are a huge deal. And that's the first thing people do when they go to look at properties. Hey, I want to go live at something Meadows, and oh, they have horrible reviews. I'm not going to go there. It's a big deal to have good property management that solicits reviews from people
Right.
too. So if they've done a good job, they ask for reviews, and
Yeah.
give them a cupcake if they write a review or something.
Cupcake properties.
Repaint their unit. You know, give them whatever small incentives, but if you're gonna repaint their unit anyway, why not say, hey, write a review and we'll repaint your unit? They didn't know that you were planning on doing it, right? Again, more things about the partner. I would say only invest with people that are actually investing alongside you, right? So, and I would say the same thing if you're gonna take private money, make sure you're willing to put some money into the game. Otherwise, I don't think it's a win-win, right? So make sure they're actually gonna put money into it. Is a sponsor? Sponsor is the same thing as a general partner. So are they actually making money? Right? You want to make sure that they're making money. And are they making enough money for it to make sense? Right? Because what happens if they're not making any money? Do you think when things go wrong, they're going to be incentivized to keep on going? If they're not making money, they're not going to want to keep going. Like, so can they actually make money in this deal? You don't want them to be greedy, right? But you actually want them to make money. And the last thing I would say is, are your goals aligned? Not only your financial goals, but are your actual, like, what's your plan moving forward, and does that align together? And probably personalities a little bit too. My final thoughts: active can be a great strategy, make you a lot of money if you're willing to put in the time and the effort, and key, if you're willing to run it like a business. Okay, if you're not willing to run it like a business, it's not for you. Passive is a great way to diversify, especially if you have a job, want to retire, great way to diversify. And that's me. And that's Kane. I already got it. Do we want to try to go through the deal, or what do you guys want to do? Do you guys? I've got a deal that I did a raise on that we can go through. I could show you kind of my slide deck, or we can just BS, talk real estate.
I'd like to see it. Battery's going dead, so I don't think Facebook's gonna see it, but I like to.
Oh, they should have braved the snowstorm.
Yeah?
I know, it wasn't that bad.
This
I'll look at an example.
Yeah. Maybe I should put the, I thought I sent you the slides.
no, it's just PDF.
Sorry, I thought I sent the slides, so this might not look yet quite as good.
Oh, I listened to that for right after
Or if I can. Okay, so here's like a typical, no, this isn't my slide deck, this is just my PDF that I put added into a slide deck, so I apologize. I sent the wrong one to Jordan, but you guys see that at all? Is that better? That's better. Best?
We probably won't be able to read the text from the background. You just tell us about it.
So this is the type of slide deck I put together. I give an executive summary, talk about the property, 224 unit B-class property. The asset is 89% occupied. We're gonna do a mid-level renovation. And I put what the purchase price is, what our renovation budget is. We're gonna spend 2.1, almost 2.2 million, so we're spending roughly 10,000 a unit, just under that. Our debt service coverage, which a 1 would be, we're breaking even, meaning our income is equal to our loan payment. That would be a 1. So anything greater than 1, you're profiting. Banks like to see 1.25 or higher, right? So we're at 1.46. I like to see properties at least 1.35 or higher.
Yeah. Can I say,
Yeah.
for debt service, another way to think of it is if your rents are, I'm gonna screw this up. So if your it's 25% more than your mortgage payment. So you just take your mortgage payment and multiply it by 25%, and that's your minimum rents that you can have.
Yeah, there you go.
Right.
Yeah.
So if you know what the mortgage payment is, you can back into it that way.
Yep, absolutely. And then I talk about what type of loan we're doing, what our interest rate, all that kind of stuff. And then try to give our key financials. Along with that, I do a big underwriting. So you as a passive, you get to see all my underwriting. But I talk about the key financials, what we're doing, total raise, what our revenues are, what our expenses are, what our total net operating income is. Investor cash flow, this is overall from the raise, what they're getting. They're getting about a 9% on average, okay? And again, this is projected. You can see their investor ROI, so that's just your normal return on investment, is 21.6%. So 20% will be doubling your money in 5 years. So we're just a hair over that, and the IRR is 17.5, or projected. So then I gave like a sample on $100,000 investment. I always try to put it towards like a monetary thing, because most people can gauge like, oh, okay, if I put $100,000, what does that do for me? So you're gonna get $9,000 during the on an annual basis, and then when you sell it, you're gonna get a total, that's including your cash flow, but a total of $108,000 back plus your $100,000 back.
Have you had many questions about that? The total profit upon sale? Differentiating between, you get the initial
Yeah.
100,000 back.
A lot of people ask that, and so I do a webinar. Every time I have one of these, I do a webinar, so everybody can join it, and then I record the webinar, so everybody can listen to it that didn't join it, and that's where I talk about stuff like this, like, what does that really mean? You're getting your initial profit back, plus you're getting the 108, but that 108 isn't just a chunk at the end, some of it's cash flow throughout the year. So you gotta remember, we made $9,000 per year times 5 years. We gotta back that out of the 108,000 at the end, right? So it's overall. I'll talk about my structure, my splits, when my payments are made quarterly, my fees. Then I talk about my team, who they are. See, even my management company's on there, my attorney's on there. That way people can look them up. Now I have a whole business plan. I talk about the purpose, what are we doing, okay? I describe the property, what is it? 224 unit, consisting of 28 buildings, 89% occupied. I give the breakdown of the units, talk about what the blended rents are, what the average of the market is. So you can see, like on this deal, we're at an average of 687, the market's at 827. So you see there's a good delta there. We can actually increase our rents. Talk about where it's located, medium traffic street, good off-street parking, all that kind of stuff. Air conditioning, low maintenance. Talk about what we did for due diligence. We walk every single unit. We review all the financials, all the leases, everything. Evaluate the resident stability in the sub-market. I actually secret shopped.
Is it fair to say you don't walk every unit before you make an offer? Like that would be during
Right.
your due diligence phase, you're walking the units?
Yeah, if you tried to walk every unit before you made the offer, the broker would,
Kill you, right?
yeah, well, they wouldn't let you.
Yeah.
Nobody would let you.
What do you see, like 3 to 5?
Yeah, I mean, depends, right?
I suppose it depends on my
If the-
vacant units, right?
If the building's fairly, like if everything's fairly equal, right? Let's say we have mostly 2 bedrooms. Let's say we have 2 different floor plans and they're all kind of in the same condition. Well, then I only need to see 2 units,
Sure.
right? If I've got 5 or 6 different floor plans, I want to see 5 or 6 different units if I can. If I've got some units that are like super outdated, some that have been renovated in 1998, some that have been renovated in 2014, I want to see
A sampling
some of
each,
those, right?
Mhm.
So I want to see what I'm going to get as much as I can.
Yeah.
And then I want to walk some of the more important common areas. So if I've got like in Minnesota, we have, a lot of properties have boiler rooms. I want to walk the boiler room. I want to see the elevator if it's got an elevator. I want to see the common area, the clubhouse if it's got a clubhouse. I want to see stuff
Mhm.
like that too. So
Mm-hmm.
I want to view as much of the property as possible.
Do you care at all if it's got a lot of buildings versus a gigantic building? Like for example, if it's 100 units spread over 3 buildings, is that preferable over 10 buildings, or do you not care at all? Just
Yeah, I do like the 1 or 2 or 3 buildings versus, like this is 28, but it's also geographical too. So the farther south you go, like in Tennessee and in Kentucky, most of the buildings, especially in like the 70s and 80s and 90s, they built like 10 units, 20 units, and they put them in one kind of complex. So that's pretty common in that era. So you kind of got to go with what the market gives you too. So, but if I were to pick, if I got apples to apples, yeah, I'd pick the.
Do you see in those where they have smoking buildings then? If there's lots of little small buildings where it's like one or two are designated for smokers and the rest aren't? I'm just curious.
I haven't seen that, but
Okay.
I mean, I'm sure you could,
Yeah.
right? You can do pets that way too.
Sure,
You
yeah.
can do non-pet buildings and pet buildings. And there is some advantages of that, but
Sure.
you do the criminal building and the non-criminal. We do a very thorough due diligence, so we talk about that, what are we doing? And then our business plan. Like I talked about, there's gonna be lower cash flow in the beginning of year one as we establish new market rents, renovating vacant units. It'll create some short-term vacancies and cause temporary break-even cash flow. We expect to lose some of our existing tenants due to the physical changes. However, once the renovations are complete, occupancy and gross revenue are expected to increase. Like I said, we analyzed the comparable properties. So I went and actually seeker shopped the comparable properties. What I did is I went into one of our main competitors and I just said, hey, I'm looking for a unit. What do you want? Oh, a 1-bedroom or maybe a 2-bedroom. Can I see both? So we went and I actually walked 3 units of theirs. I walked one that they hadn't renovated, and I walked 2 that they had renovated, different floor plans. And I was able to see what they're charging in rents. And I was able to see what they did to get those rents. That was really important for me, which was great because they were achieving far greater rents than I underwrote for the type of product I wanted. So that was a very positive. And this property actually backs up to my property. So it's a pretty good comp. We talk about total renovation, stabilization, how long it'll take, how long the lease up will take, kind of what we're doing to the property, and then how long it's going to take overall in that process. And also here I go through what we're doing, landscaping, all the exterior stuff, all the interior stuff. Try to give some pictures, before and after pictures. This is actually one of my properties. This is actually a 1-bedroom unit and a 2-bedroom unit, but this is what one of my properties looked like. And then we changed out, made it like that. Here's another one of my properties. Bathrooms. Kind of hard to see because of the lighting. Living rooms, not exactly the same units, but it's a nice couch. And we try to give market comparables too, so you can kind of see where the rents are at. So you can see a few of our competitors' properties and kind of where they're at for the rents, what their square footage is, and versus what ours are.
This is CoStar.
Yep, so this was taken from CoStar. So that's the property that, or is our probably our best competitor right there, that they back up directly up to us. And these rents actually stated are actually quite a bit lower than what they're getting as I went to the property. So I based it kind of on this, and then I went to the property and found they were getting way higher rents. That's their blended average on their non-renovated and the renovated. The renovated are getting substantially higher rents. You can see, where our rents are compared to the market. And there's our sales comparables too. So we can see about what we can get. We show where our rents has been going. Our sales volume, where our sale prices have been going. And then I do a whole thing on the economy. What's happening. unemployment rate is falling, job growth is happening, current employers, strength and overall economic diversity, all that kind of stuff. Try to talk about the positives of the city and what's happening there. So a lot of healthcare moving in. You know, Memphis is a really big on the airport there. They got a big transportation hub as far as industrial transportation goes. Second busiest cargo airport in the world.
Hmm.
Behind-
FedEx is based there, correct?
FedEx is based there.
There you go.
Show our spread and how much, where our job diversity is. What our unemployment rate is. Where our future job growth is projected to be at compared to the US market. So we're actually looking to be higher than the US market overall. And then some of the new jobs that have been coming in. So try to break down who's bringing in jobs. Amazon's the big, word of the day. They're bringing in 1,500 jobs, but all these other employers are bringing in a lot of jobs as well. And some development that's been happening.
FedEx is bringing more people in because Amazon said they're bringing people in.
Yeah, probably.
Should they cooperate?
They cooperate together, yeah, definitely. FedEx understands that that's an opportunity, and
Yeah,
I'm sure Amazon understands it's an opportunity as well.
oh, sure.
Yeah,
Sure.
Amazon's buying up airplanes, but right now FedEx is still like your major source
Oh,
of air
yeah.
cargo.
Good point.
So that's kind of our, my main slide deck that I show. Like I said, it usually put in a it is in a PowerPoint. I just sent the wrong one, but just try to pinpoint what's going on in the market, why we think it's good, here's where we think the market cycle is versus, so we think we're still in the expansion phase on this. I feel that Memphis has got some legs still. In our economy, I think that some markets, including, I'd say, the Twin Cities, are probably close to the top. Maybe even some of them are trending downward, potentially the Twin Cities. Our construction, and then some few highlights, and that's about it.
This also didn't die.
That's all I got, man. I'm all out of goodies.